So here's the story. We have internet connectivity. I'm going to start the recording. It's gone on 9/13. No offense, the internet's okay, but as you notice, we lost connectivity with our charts. This might be a very... we have started the recording, so good morning, everybody. Sound check is good. I'll try to do this and sum it up in 48 seconds or less. I'm still bullish the market. I don't think, if you go over here to your document tab and highlight for all, there it is, right there, you can get your unabridged, I wrote it, don't worry about the typos, the grammar, it's being cleaned up professionally before we do what? Send it out to email so people don't think I'm completely illiterate. But I wrote this, I think, on Saturday, if I'm not mistaken. How much time did I spend on this thing? A little bit, close to, you know, a bunch of time. So in any event, maybe I spent too much time. About 2.5 hours. Took about 2.5 hours for this. So, you know, this is not, I'm not bragging, and I'm not looking for, but this is the kind of time it takes, and I would have to say this takes 13 seconds to write up. And I think it's very important because people do take time away from the markets. I always get scared to go on a vacation because I feel I lose that, my edge, my sense of market. Just let me explain this to a minute for you guys, because this is really, really, really insanely important as a trader. At times, I'm just going to share with you what I've gone through, and I've only done this since, as trading goes, my first actual trade, I had been reconnected. Here's a quick story. This is being recorded. John Bollinger called me up. We're doing a thing in Italy, and he goes, you know, John, I've known you for years, and I mean, that's being humble. I think I've known John for 20 years, but needless to say, we've been on panels together, we've traveled, we were in Hong Kong together, we've been in Italy together on different panels. And he goes, I didn't realize you worked for George Lane. I knew George very well. I said, well, and it was almost as if he was quizzing me to find out what I did or didn't know, or to, I think, maybe to see if I was BS or whatever. Then I said, well, I worked for George until about 1982. It was actually his wife, Carrie, who had me fill out a bunch of documents and fill out these forms, go get fingerprinted, and I got registered with the Commodity Futures Trading Commission before, get this guys, before the National Futures Association, which is the self-regulatory body of commodities, the National Futures Association, NFA. NFA was formed at the end of 1982, and I actually was registered March 1982. I started with George in late 80, mid 80, something like that. And so anyway, you know, we always say I actually started on the floor when I was 16, but we really don't count that because that was just a summer runner's job. But literally it was 1980 when I was working with George at a company. He was the research director called Commodity Corporation. I can't even remember. Wayne Elliott was a wheat trader. He was a member of the board of trade. He owned the firm. George, his division was called Investments Educator. His wife, Carrie, we got along great. I mean, they really had me do a lot of stuff. I was a gopher in the beginning. Go get lunch. Go get this thing over at E.F. Hutton's office. Do this, do that. Go get the report off the gosh, I don't even remember. The Reuters, it was like a big, huge roll of toilet paper, and it would just print out in white and a yellow carbon copy thing of all the reports, like money supply on Thursdays at 3:30 when M1 meant something back in 1980, 81. The Dow Jones Industrial Average, as I recall, was at around 890 when I started there. Ironically, a man by the name of Joe Granville was calling for the biggest market crash in the history of mankind in those years. I say ironically just to give you a little lesson in life because I used the indicator he created called on-balance volume. We teach that in this room. We're at the Money Show. If you come to the Money Show, you will not repeat. You will not see me talk about this anymore in general public anymore. I'm not going to talk about on-balance volume anymore, especially at some of these events. Private events, yes. Public events, no. That's my promise to you guys in the room. Dr. Scott was in my office the other day, and he said, well, why would you do that? And I said, well, if everyone figures it out, then it probably won't work. And I don't mean to be selfish, but this is a zero-sum game to a degree, and we need losers in the market. And I don't mean to be selfish, but that's where it is. The funny thing is, I could teach people, and that's where I probably learned from George, because George used to drag me to places around Illinois and teach farmers about stochastics and trading, and he really had a passion for getting them into hedging and protecting their asses financially. He was just dynamic to see in person. I reflect this because I was giving John Bollinger the details, and he said, did you know George's daughters? I said, no, he didn't. The kids didn't come around. That was from another marriage. And he says, wow, yes, you do know him. And I kind of like went, what, are you quizzing me? And I said, of course I know him. I talked to George about 3 times in the late mid-90s before he passed. He had several strokes, by the way, and he could not do anything. And in 2004, he was 2004, I guess. Maybe it was 3, maybe it was 5, somewhere there. It's been a decade, for God's sakes. He was kind of bedridden. And, you know, I owe my knowledge to him. He was a mentor. He was, I learned, I often tell you guys, I watched him day trade using 5 and 15 combination time periods. When you move down to the floor had these alphabet letters that identified the time brackets that changed every 15 minutes. So from 8 to 8:15, and I, you know, to be truthful, right this second, I don't remember the time bracket. I think it was E. I could be wrong. K was whatever it was. L was mid-morning, as I recall. So you would write down on your card who you traded with, his badge, the price that you did. Buy was on one side of the card, sell was on the other side of the card. So if you were a buyer, you wrote down who you traded with, the time bracket, and the price, and you turned your cards in. So anyway, just a little history for you, because, by the way, guys, all of this will change in a few weeks, because the Chicago Mercantile Exchange is closing all the floors except for options trading. So if you've never seen the movie Trading Places before, it will become a movie that's obsolete, kind of like a CD player. I mean, some people might have CDs left in their closet, like me. I never had 8-tracks or albums because of the album art cover, but due to creative, destructive innovation, in other words, something's created and something gets destroyed. Apple kind of reinvigorated the music industry, but destroyed, you know, just countless of businesses. The internet, stuff like that. Uber is kind of interfering with cab drivers' incomes to a degree. So there's all kinds of things out there. Why do I bring this to your attention? Well, you know, we need, as traders, if you get too caught up in everything that's going on in the market, one thing that I did learn from George is the man took time off from the markets. He took time off. And when you go through a good phase in the market, sometimes we get the Superman complex that nothing can go wrong. We push our bets, we press a little too much, and then you get taken away. Flying out here, I saw probably one of the most depressing, worst movies that one could ever see on a plane coming to Las Vegas. It was Mark Wahlberg in The Gambler. Don't see the movie and come to Las Vegas. It's really kind of depressing until the very, very, very end. Where he presses his bets, he won't walk away, he doesn't know when to take money. And I've insinuated in this trading room, I've demanded in this trading room, when we've had good weeks and good months, you call your brokerage firm, you ask for money back, and you see that check, you know what, you've got to get money out of your account. You've got to walk away. This is a part of really trading. I can sit here and teach you everything about technical analysis that I know that works in this environment. I can teach you about specific trades like spreads to help reduce risk, reduce your capital outlay. That's why we put spread opportunities out there. We have option trades that we've done to help manage risk while increasing the leverage on our leverage. Like instead of taking a 5% move in a stock, you can maybe take 100 to 150% rate of return on an option. So we've done a lot here, but man, it comes to the point where you will get burnt out. Several weeks in a row now, I've been putting out some positive thoughts that might be weak positive to a degree, but what they are is they definitely are thoughts and actions that you need to do. And I think you get burnt out either one of two things will happen to you. You'll start developing bad habits like overtrading, maybe increasing your position lot size that you shouldn't, and that's called managing position sizing techniques, and as well as managing stops. I mean, everything's all relative in that game. But in any event, we go through this periods in the market, and I think that you need to take time out. And I'm not telling you this because for any other reason that I need to take time off, but I think this market and this environment, we had a high level of anxiety market for the last 6 weeks. Between Janet Yellen, unemployment reports, earnings seasons, up, down, left, right, the whole year. Is it going up? Is it going down? Is it crashing? Is it burning? We've tried to help maybe contain, maintain, you know, a sense of I think, priority of what this market's going to do, and give some ideas. And you know, I think I know we've had a great year. We can always do better. I realize that. Both are as a point of bragging now, or a pat on the back. PA stock alerts, not every trade's a winner, but by gosh, open close positions, I mean, the performance is stellar. Last month, just starting and launching a small little fund, and I'm getting into the managed fund. We've launched a little hedge fund here. And we're up, you know, safely to say, you know, since we launched in April, we started actually real trades in April, and as of Friday, I think we're just over, I can legitimately say, over 3% in that time period, which, you know, 3%, I know everyone can do better on their money, but when you're responsibly trading, you look at risk to reward, drawdown, that type of thing, how much money is invested at any one point in time. And I'll be honest with you, in a marketplace that year-to-date gain is 3%, and we've fluctuated, if you recall, last week, on Thursday, the S&P 500 was unchanged on the year. We're back up to about 3.5%. And that's moving an index dial. That takes a lot of activity. Anyway, do take the time to understand that when you are up and you think and know that you're going to come into a difficult time, and maybe this week could be a time of reflection and maybe lighten it up. It's the money show. We have options expiration, and after next week, if you feel you're a little burnt out, and you don't come into the room and everyone goes on a family vacation, take a little time off, man. Make it a 4-day weekend if you have to. Take off a Thursday, Friday, and then a Saturday, Sunday. It'll do you a world of good. You can still keep your eye on the market at the end of the day. Come in here on a Monday on planning and scanning, and we'll give you the skinny. Any event, you can look at all of this last week. This just gives us what the last week performance was. The S&P, very surprised. It was like not a great performance. On a week-to-week basis, week to week, the S&P's was only up almost 0.4%. The Dow was up almost 1%. The Russell was up double 0.5%. The NICE was up 0.5%, and the Qs were negative on the week. Best performing sectors, biotech, and I think it's going through a longer-term distribution phase, and we see this, and we'll go over that a little bit today. But definitely, no doubt about it, financials, as measured by the XLF, up 1.73%. I think we got ahead of the game there when we came in about 2 weeks ago and said, hey guys, you know, seasonally speaking, bank stocks go up a little bit, and we want to focus in on some bank stocks, and we looked at one of the better ones, which I thought at the time was Bank America, traded it effectively. And I know that when you look at the performance, the relative strength analysis, you'll see that it was the banks, both, not just the XLF. Now, keep in mind a little quick lesson for you. XLF is not a pure bank ETF. It's mixed. It's got the CME, a commodity exchange. It's got Metropolitan Life, an insurer. It's got American Express, a credit card, and it does have banks, Citi, Wells, and Berkshire Hathaway, for example. So anyway, those are kind of like the top 10 holdings, just to give you an idea. It's a diversified financial ETF, not a pure bank play. So what happened? The KRE, the regional banks, was up 1.62%. Major banks, the BKX index, up 1.5%. Look, consumer discretionary only up 0.3%, and transportation only up 0.3%. But look at this, homes, and we've been talking about homes, and I didn't want to see this thing pop as much as it did last week, but watch for pullbacks in here, because the ITB, and that's the ETF that measures the actual home builders. There's two ETFs that people claim measures as the home builders. It's the XHB, again, the XHB. The XHB ETF measures what I consider or call or refer to as the peripheral home builders, like the companies that, you know, have products that go into a home when it's built, like Sherwin-Williams, Bed Bath & Beyond, Home Depot, things that people would go buy paint, supplies, stuff like that, all right? But the ITB actually is for the builders, Lennar, Toll Brothers, Pulte Homes. I've taken the time to include not just the names, but the stock symbols so you can track those down. The worst, biggest losing sector was oil and gas, XOB, down 4%. Oil services down 1%. Now here's the kicker. Last week we came into the room. I think our timing, I might not be here every second of the day, all the time, but we identified that, hey guys, 62 is going to be, and it was on the Energy Wednesday after the report. They had a kind of a blow-off top. We identified there'd be resistance near 62 on the charts. We identified the market might pull back and then give up an area to sell for scalpers. Now, here's what I should have done. I should have said, by the way, guys, if we're looking for a correction, here's several trades that we would look at if you're not in positions. And I was in a bunch of positions last week, so, I mean, I didn't just come out and say, here, sell it. But I think I did tell you if you wanted to scalp it, here's the areas to look for. So this is kind of like what we ought to do is get together in this room, and up here in the notes page, we've had several contributors. This is Sonia and Andy and Bill W. are, I mean, these guys are awesome. They're and Jeff Scott, they all have access to come in the room and say stuff. And it looks like Bill McKee took the time and liberty to re-quote stuff that's right out of some of my books, which is pretty important stuff, by the way. And what I would like to say to you is that we ought to have, and I thought I did have in here at one point, a listing of like a pass play. If bearish, maybe we look at spreads, future spreads. You can sell the front month and sell it far out, like sell the June crude oil, but yet to reduce your margin requirement, maybe buy the July or August contract against it. You can hold it overnight. If we're wrong and the market shoots up, you're just looking for a differential of the spreads. We've also, I think, can look at maybe options on USO, like a credit call spread, and take in some premium when we see that. All right, so and when I started off saying not only do we need time, but if we take time off from the market, man, you get a little fresh and you can say, gee whiz, guys, you know, we got several ways to attack this market. Sell it outright, spread it off. You know, as I always teach and I was taught, when you're in a trade, you got three choices. Spread it off, double up, get out. When you're not in a trade, you have several opportunities. An outright, a spread, an option, other opportunities. So I think what we can do is start to take advantage of some of these trades or these situations. So in any event, I left in here, and I want to keep this in here in the report for the week, because I believe towards the end of the month, and we probably need to take Yelp out here, because Yelp announced they're up for sale and the stock had an immediate reversal. And I mean, I think that was a stock that really hurt some people. It went down, stopped everyone out. There were some big losses. People held on. If you were doing an iron condor, I don't think that worked out too well for you. But stocks I like still, Pandora. But I think we need to watch Pandora. And I don't know if that support of 16.5 is going to work. I still like LinkedIn. I don't think that support's going to work, but it's the timing event, and it's more towards the end of this month. Like, we'll look at this in to the end of this week after our option expiration to the middle of next week. We'll be taking a look at some of these social media stocks again, okay? So I think what I was saying, that I thought we would see the S&Ps in my work up near 5% by the May option expiration, or at least by the end of May. And I revised that at least by the end of the May, I think 2 weeks ago's planning and scanning. I may have been a little overzealous there. And that's what we need to hit in the spiders, 214.87 monthlies. And I think we're going to still get there, by the way. As of Friday, spiders settled. As you can see, we're only up just under 3%. So we're here in Vegas just to let you know what's going on. Yours truly, no doubt about it, is going to be a little on the jet lag side because you eat dinner at 8, you go to bed at 11, and you get up at 4:30. It's rough. But this week, we have May option expiration Friday. It's a mild week for economic reports and earnings. And it looks like we have a really concentration in some of the retailers. Nordstrom's, JCPenney's, Macy's, Dillard's is another one that's coming out. So I just wanted to let you know what's going on. Technical points of interest. We're all still in buy mode in all the markets. The Russell still remains in a sell mode. It popped back up to weekly resistance. Weekly AD readings shows we've made a new high by a few ticks on a weekly AD line. You can see it right over here. The weekly AD line in the S&P's made a new high for the year. That, my friends, is bullish, and it shows accumulation. Remember, S&Ps have financial, transportation, energy stocks, and with XOP down 4%, and we still saw a majority of stocks, the participation rate from a week-to-week basis making new highs, it's tough to get bearish in the market. Now, that's a weekly advanced decline. So what that might suggest is that this week we pause and then we see multiple weeks of increases near pivot resistance. The month of May, my pivot is still above the 3-period pivot point moving average. It gives us a bullish bias, but it gives us a lower targeted high. And so for the month of pivots, looking at this, or the quarterly here, looking at this, it's giving us a bullish quarter here, guys. A real drag. Any event, volume levels did improve, and I'm not talking daily. So in the daily on-balance volume, it didn't really see a tremendous breakout in most of the markets, except for, and this is bizarre, and we talked about this the other day, the Russell. The Russell accelerated. The Russell accelerated in volume on a day-to-day basis. The Russell's OBV is still trending higher. I talked about this last week and say we probably want to focus possibly into Russell stocks, and small cap growth stocks could be back on the table, and that's what that volume suggests. They did not liquidate, but they liquidated. Look at the direction that I'm pointing to in the volume OBV. It's the one in the middle. It says OBV. It's labeled for you. The volume on a week-to-week basis in the Russell's pointing up. The volume on a week-to-week basis in the Qs is pointing down, and that could be because of the biotech. That could be because of the biotech influence. All right. So when you look at the advanced decline, and this is the NYSE, volume picked up a bit. It's not bearish. It's not certainly bullish. The diamonds, the Dow, we made a new weekly high. We didn't make a new yearly high in the advanced decline. What I mean by that is we had a high back over here, comparing an apple to an apple. And if you note, and we just go and take a crosshair examination, we've popped our head, and if we take a look, and there's only 30 stocks here, and it's not the influence of Apple weighing the man down. It's that and that could be Exxon, and that could be a few other names in there that kind of weighed on the market, like Johnson & Johnson, et cetera, that are Dow component stocks. So any event, but it is positive. And the volume, we never saw a tremendous volume shakedown on a week-to-week basis. The moving averages are pointing up on a week-to-week basis. So we're not done to the downside quite yet. It's a matter of weeks. When we look at a weekly analysis, I don't know if this is the week that we break out of this range, but I can tell you the indexes are still healthy from a technical point of view. Most retail traders are not probably this tied into this type of analysis, and what they will be looking at is on options, implied volatilities, things of that nature. In the options But when you look at the VIX, the VIX has not been a very helpful tool for a lot of traders. And I think it's always best to look at some of the technical tools that we have. So with that said, weekly volumes improved in most index except for the Qs. That's why I wanted to go over this with you so that you could see what I'm talking about, learn from it. And most of you have either the lifetime package of the TradeStation or the Genesis, and so these are the tools that I've created. You know, when I asked Genesis, I said, I want the AD lines, and you know what, keep that for Genesis. But do create that. And they had no clue why I was asking to do it. It had not really been something that a company really was familiar with. And that's why if Genesis didn't know about it, trust me when I tell you, not a lot of firms have this. And I've done a lot of seminars for Thinkorswim. Cindy Favor, she's a great person. She took a lot of notes every time. You know, I would be doing presentations, and I know that if Jerome was in here, he would know that go out to the Silicon Valley option group out there. And I gave a presentation, and a couple people were, maybe it was late in the afternoon and people were a little tired, but I'm giving this type of information, and only one person, literally one person in the audience was taking notes, and Cindy Faber next to me was taking notes. And she goes, man, this is great stuff, John. I'm going to have this added. They didn't get it right, though, but needless to say, they didn't get the comp lines correct in all the markets. So the point being is, even if some platforms have this type of information, it's not correctly done. It's not accurate. And so you guys might wonder, I'm getting bored with this, John. You go through this every week. I mean, come on. What is this good for? I think you noticed that it's kept us on the right side of the market all year and last year and the year before. So it is important. So let's take a look at one last thing. McClellan oscillator level, it's the weekly level is now above the 35, the positive reading. It's at positive 35. Now, we went from negative, and I told you it's going to cycle to about maybe, how many weeks did I say a few weeks back? It's going to take time for this thing to cycle back from oversold to overbought on a week-to-week basis. We're getting, that was a big major shift on the weekly McClellan oscillator. Funny thing is, the daily is still below the zero line at negative 31, but the prior week was negative 93. It is becoming more positive, but it's still not oversold. The next 11-week cycle, and I really wish my buddy Mark was in the room, because he was an old floor trader, bond trader, and you know, he remembers when I first came out with the identification and published this in the financial journals about the 11-week cycle, and we talked a little bit about that. But it's due in the middle of July, which, by the way, is not that many weeks away. So this week, I've taken the liberty to giving you guys some stocks that I still think are very positive that we can follow through for the week. As a disclosure, I'm still long American Express. I'm still long Bank of America. I'm still long Broadcom. I am long Fluor already. I kind of believe my own stuff when I talked about this with you guys last week. And those are the position. Still have a mild position in long on Morgan Stanley, by the way, personally speaking. These stocks right here in the drug sector look the best from a volume, both short-term, long-term. Seasonally, they're not great. These are some of the better names for the week. Look what I've got in here. I've got some big bank like Morgan Stanley. I got a credit card. I got the little guy Bank of America, which I'll still watch. But this week, USB's new on the list. So we want to probably look at USB. And then PGR, Progressive. That's an interesting one right there. Agriculture, Monsanto pops up. So take a look. Monsanto is in the what? Ag space. There you go, DBA. So when we take a look at, the funny thing is, the strengths and weaknesses, this is supposedly a strong time period in May for the energies, and they didn't do well. They got sold. So did they not do well, or did they get oversold and take some profits? And I think they got oversold, and there might be some buying opportunities in there. So unfortunately, I didn't see anything in the energy space. So in the industrials, I like FLIR. I like TXT. Consumer discretionary. I think CarMax popped up on my list for whatever reason, and TripAdvisors. So a couple things. Priceline came out with earnings. Last week they had negative reaction. But this is the time where people start to get online now through August and start making their summer vacation plans. So on weakness in some of these online internet, keep in mind, think forward. Think forward. As we get through, we'll be looking more in the internet, social media, and online, let's call order your vacation type companies like a TripAdvisor. Real estate, TCO, technology. Cisco has earnings on 5/5, and I think, by the way, Cisco's got surprised to the upside, and I'll go through that with you. These are seasonal spreads. I didn't have anything except for natural gas. Let me explain when I put these out. These have a history of seasonality that have over 80% in the last 20 years of working. So I don't just put something out there just because I'm bored. These spreads have actually a track record of being 80% profitable over the last 20 years. So that means mostly in the last 20 years, at least 16 years, these spreads have been profitable. Will they work this year? I don't know, but these are the high probability spread trades from a seasonal perspective that we look at, and I just wanted to review that with everybody. So if you look at today, we've got, Gina Parkhurst. I don't want to throw you under the bus, but you know what? I always get by with a little help from my friends. This is not a one-man show. People stop by my office like Jeffrey and bring me desperately needed coffee. People send me desperately needed presents like over-the-top chocolate, which has a little caffeine in it and a little brain power food, a little over the top, 3 pounds of it, for Christ's sakes. But I mean, I do have a lot of good people that I surround myself with, and everyone in this room qualifies. Gina Parkhurst, you're a dear heart. Sends me an email. Hey, don't forget, you got the ECB, the European Council talking this week about, what to do with Greece. Well, they have to bail Greece out. I'm here to tell you. The austerity program, it's not going to change. They're bankers. They know they're screwed. They're just going to milk it for a while. Last week, we also had another amazing, shocking to me, situation. Australia lowered interest rates. So how many foreign central bankers just did quantitative easing or reduced eased monetary policy this year? I lost count. I used to have it, but I lost count. In several weeks ago's Market Thoughts, I think it's either 17 or 27. I can't remember the number. It was just incredible from like the first of the year this year. By the end of January or the end of February, I think it was 17 or 26. I can't remember the number. I wish I could. Maybe you guys remember for me. How many central bankers enacted some sort of quantitative easing? It's pretty crazy. So in any event, that's not in the list, but it is something that's happening around the world you probably need to focus in on. Earnings this week, I probably shouldn't even have typed this up. It was worthless, but bid is Sotheby's. I don't see how they could do bad. Dish Networks might do a little bit better, but here's the guy that's the one that's to beat right here, Cisco. Cisco, but keep in mind, Roundy, I think is a food store chain, so you got a couple food guys coming out this week, by the way. Kohl's, I forgot about that one. That's another. So when I tell Perry Ellis, that's another one. Jack in the Box, Nordstrom, Symantec. So we do have a few names to find out how they did. I put Zillow last week because it's what my sources said, and they apparently either delayed it or it was misquoted, but Zillow I have as after the market close on Tuesday. So the fact that there wasn't a big reaction on Zillow last week, I would imagine it isn't. I know Shake Shack is a big thing. There are no options on Shake Shack listed yet. It could be wild. It's a big mover, large capital. You live by the sword, you die by the sword. You go for the big big moves, and you're going to get lucky every once in a while. And sometimes, you know, I do not personally believe in trade little and trade often. I don't believe in that. I believe in, you know, get your ducks in order, put a good trade on, and if the trade works, then you manage that trade. I think you'll notice our track record's pretty good in doing that. So we might not trade all the time, but we definitely look for high probability trades, and we keep you guys, you know, on the straight and narrow. So I wanted to go through what the hell happened last week. What are we looking at still for this week? It's option expiration. Technicals still look great. My 11-week cycle finder, you'll note that it does line up a lot of times in looking at peaks in the market, looking at peaks in the market, looking at peaks in the market. Some weeks it was a week early and the market did have some follow through. This week did not work. This week looked at a sell-off. It just went sideways. This week was kind of a week late, and that's what I say. In cycle analysis, I want you to be familiar with the term alternate cycles. People, they look at a cycle and they say, oh, it absolutely is going to work. And sometimes it doesn't work that signal. It will work probably the next signal. The next cycle I thought I had on the 18th. I'll change that. It's actually the week ending 7/3, July 4th weekend. So the end of June, baby. I will change that. I don't know how in the hell did I miss that. I must have been. I just want to. I'm glad I kind of show this stuff to you. The 7-week is not on 7/18. It's on 7/3. So I'm going to change that. Make sure that you do change that. Change that on your own document, by the way. Okay. File, save as what? Save as, shoot. Save as that. There you go. It already exists. Okay, do it again. I don't care. Anyway, that's. I'm glad I went through that with you because the 11-week cycle, as I talked about, I wrote about in my book, my very first book, that little badass little book that was written in 2003, published in 2004. It was the manuscript from me training my brokers when I owned a brokerage firm. That's how that book evolved. Just a little history if you'd like, because I know I talk too much, but Daryl Jobman at the time was the editor, managing editor for Futures Magazine, and Daryl was familiar with my work, being in Chicago, blah, blah, blah. And I wrote a bunch of articles for Futures Magazine, and I did an article called Pivots and Cycles. And I announced the 11-week cycle, which was going back since like before the crash of long-term capital management, before the crash in technology stock in the S&Ps in 2000, this September 9/11, the week of 9/11, right before that was an 11-week cycle, and it just went on and on and on and on. And I think I shared that with you guys a couple weeks ago in the room. Anyway, it still is in effect. With cycles, here's a quick little lesson for you. You do have to adjust them every once in a while, because what happens every week? Well, every week is different. Every year is different. You got a leap year. You got holidays, right? So if you don't trade on a Monday, and how many holidays in a year do you get? If the markets are closed several days, it'll skew or throw off your cycle. So you kind of have to adjust them a little bit. But in any event, you back test them, you go back, and on a visual perspective on a weekly, for a bull market, for God's sakes, if you knew several weeks in advance that you're coming up to a cycle and you paid attention to a sell signal and had technicals like the volume's not great, you might get a little bit more of a sell-off. We had a sell-off. We had a weekly sell signal coming. The market already sold off in that. So last week would have been not in a cycle. The technicals still look good. And so therefore, we were still saying, hey, guys, if we're going to be, if this thing's going to be bearish, then, you know, we will see this market. And I gave you 2 points of interest. We got to close below, just not that low, but we got to close below that low, and we didn't do it. And the next thing you know, here we are. It didn't mean that we shouldn't have hedged, and so we did. So just to give you a roundup about what we've been doing here, one day of 1 week, this thing's going to crash. And I always told you, I don't want to be the idiot that said, oh, don't be hedged. The market can't go down. I'm not that guy. I'm pretty realistic. But we did say take off half your position in SDS, see what happens in here. And boy, if I had a perfect crystal ball, I would have said, just buy more calls. Forget about it. Just blindly load the boat. And, you know, at the very least, in here, as you can see, as I'm going to talk about right now, as you can tell, we've got more long shadows, which is accumulation. And I'm here to tell you, every time we've gone down, and I did this last week, we've seen a rise. We've seen a rise. And I think we are going to see a rise. It's just that when I look at the advanced decline, this is the first time all year, or in this rally mode, that we've seen an accumulation and, in addition, an uptick in volume. So this could be, in the next, not 1 but 2 weeks, the time that we finally break out. And I would say that because these long shadows in here have been showing accumulation, and I don't think people that are buying here are only just buying to you know, trade up against the trend. I think they're buying to see a not the market test the top end of the range. I think this is accumulation that's looking for the market to have follow through. All right. So that's my take in the market. And if we are to see, you know, accumulation, I wanted to give, and I took some extra time to go through some sectors that are still kind of in at least consumer discretionary, XLY. It's not in a great time period of being a buyer. So if you look at consumer discretionary, people might buy cars and people might go on trips. So I don't have a whole lot in the consumer discretionary. Notice that even though the energy is supposedly seasonally strong, guess what? I don't have any energy stocks there for you. But I did pick up what I think in the banking sector, a little bit in the technology sector, and I wanted to stick with sectors that were, you know, acting good and seasonally strong. Now, the Qs, later this month, Qs start to pick up, by the way. Let's examine that. And maybe if I took a little extra time, I would have shared with you guys that sometimes it's not the seasonally strong in the beginning of the month. Maybe it's a little bit seasonally strong towards the end of the month. So mid-month, we might see some recovery in the Qs, but I'm not looking for a really healthy, outrageous rally. But when we look at the market analysis, there's not great volume in this, and you know, the advanced decline is still healthy. So I think game on from a traditional seasonal perspective of looking for a rally, but unless volume picks up this week, not next week, not 4 weeks from now, but if volume does not pick up on my weekly analysis by Friday, so if you're coming out to the seminar, that's great. We as you know, I don't load the boat of hundreds of people or 20s, 50s of people. We generally have a very small community. Most of you guys are like now become friends. You see each other at these events, and they're very small. And so, you know, I like maybe a couple dozen people. That's about it. It takes time away from your life to get out here. Vegas is kind of tough, but man, we're going to cover a whole bunch of stuff. For those that remember the fateful event that we did in May of 2011, we did a live trade. Did a low closed doji on an E-mini S&P. I was dying in pain. I thought I had a neck problem, pinched nerve. It turned out I had 3 pulmonary embolisms. I lost a third of my left lung because I'm a man, I'm stupid, and I didn't ask for help, and I didn't want to see a doctor. The point is, it was also Friday the 13th. So my promise is, by the way, I'm slightly superstitious. I will never do an event on a Friday the 13th. And guess what? This is not going to be a Friday the 13th. So we've got that going for us, and I got a lot of great stuff coming at this event. So I'm excited to do the 2-day seminar because, believe me, there are probably not many left in me. So come to the seminar, enjoy yourself, and we'll sit down. And, you know, I think it's going to be a good time with great people, and that's a fact. So with that said, I'm kind of done with my intermediate term analysis. I wanted to explain what's going on with the weekly thoughts. You know, we could probably see an option expiration, 2-sided trades today. I want to be maybe focused on this week, as I've already pointed out, a couple little items. Some of stocks like these financials, and keep our eye there. Broadcom, keep our eye there. And I want to focus on Cisco with you guys in just a few minutes. As far as big note, there is a Fed speaker coming out. I forgot who it is. It's not important. It's not Janet Yellen. And for her version, and I heard someone refer to what she said the other day as it's her version of Alan Greenspan's irrational, not rational, irrational. Oops, another typo. That's an important typo. Man, I ought to read my own work before I put this out. Irrational. Oh, shit. That's an O. That's a definite O. Oh, gee whiz. That's a big typo there. Irrational exuberant speech. It sent stocks a little bit in a tailspin, but we recovered. I mean, the girl, she actually says, yeah, I think stocks are overvalued here. And I think bonds are overvalued. That's crazy. That's a crazy thing to say. Anyway, this was a shorter than normal recording, and I hope we're still projecting. But needless to say, everybody, I will be looking for irrational exuberance. I better go over and type this up again. What do you think, folks? I was so excited to get this out.